Business Link Alberta acknowledges and respects that we are on traditional land, meeting grounds, territories, gathering places, and traveling routes of Treaty 4, 6, 7, 8, and 10, and the home to many First Nations, Métis, and Inuit people. In the spirit of reconciliation, we acknowledge the lands of those who have come before us, reside here now, and in the future. And welcome again to our session on Fundable, what lenders and investors look for. Today's webinar is designed to help entrepreneurs better understand how lenders and investors actually evaluate businesses. And many entrepreneurs assume that funding decisions are based entirely on maybe revenue or business ideas. But in reality, lenders evaluate several key factors, including how a business understands its numbers, its market, and its strategy for using capital. And in today's session, we're going to explore a number of different topics. A few of those key activities being really the key criteria that lenders evaluate before approving financing, the common mistakes entrepreneurs might make when requesting capital, what a lender-ready business plan actually looks like, and how to position your business more strategically when approaching lenders. Now, my name is David Beta, Manager of Client Services here at Business Link Alberta. If this is your first time joining us, we're glad that you're here. Business Link Alberta is a government-funded nonprofit organization that supports small businesses right across Alberta through free one-on-one advice, market research, training, and various other resources. And today we're excited to be joined by Udayan Chavla, hopefully I pronounced that correct, who's President and CEO of Vajra Capital. So hopefully, again, I pronounced those correctly. Feel free to let me know if I haven't. Udayan is a chartered professional accountant, CPA, and chartered business valuator, CBV, with extensive experience advising small and medium-sized businesses across multiple industries. Through Vajra Capital, he works closely with entrepreneurs to support everything from business planning, capital structuring, financing strategies, and acquisition funding. His work focuses on helping business owners to understand what makes a company truly fundable and how to approach financing decisions with clarity and confidence. And I'm very excited to have him with us today to shed some light on this really interesting and important topic for small businesses. So I'm going to hand things over now and we'll get going.
Thank you, David. And I'd like to thank Business Link for inviting us and for everyone that's attending today, spending their lunch hour, trying to learn something new. We always appreciate intellectual curiosity, and I think there couldn't be a better mix of all three. So I'll quickly start my presentation here. I'll start by giving you an overview. Firstly, before we get into the content, I'll walk you through what we're going to cover in the next 40 minutes or so. We've got 5 core segments. First, we'll talk about how lenders actually think, the 5 factors behind every single financing decision. Then we look at the difference between debt financing, equity, and growth capital, because these are not interchangeable, and choosing the wrong one can cost you time and money. Third, I'm going to walk you through what I call deal killers, things that quietly kill applications before they even get to a point of decision. Fourth, we'll cover franchise and acquisition financing rapid fire, because those deals are structured very differently and they may or may not be relevant to the audience that's currently present. And finally, we'll give you a readiness framework, kind of a self-assessment that you can use this week to figure out exactly where you stand in the process and how you would want to be approaching a lender. We'll have a live Q&A at the end. I'm really looking forward to an engaging session and your questions. And for anyone who wants to dig deeper after this, we are going to be offering a free strategy call for attendees. So I guess let's get into it. A quick word about who we are. Vajra Capital is an Edmonton-based corporate finance and strategic advisory firm. We founded the company to close the gap between entrepreneurs who deserve financing and the lenders and investors who are looking to deploy capital. That gap exists because most business owners do not know how to present their business in the language that lenders can understand. Our name comes from Vajra, a symbol in Eastern philosophy that represents strength, resilience, and the power to transform. It's with that ethos that we approach each and every client and each and every project. And our mission is to provide the highest quality, data-driven advisory and execution services to improve the small business commercial sophistication and act as their critical growth engine throughout the life cycle of their business. We've helped over 100 clients in Alberta, achieved millions in business loans. Some of the stats you're seeing on your screen are just the performance metrics from just this past year of 2025. I'm not saying this to impress you. I say this because I'm about to share with you what I'm about to share with you today comes from real experience, lots of reps in the process. And these aren't theories, but patterns that we have observed with each and every successful or failed deal that we've worked on. With that context, let's look at how lenders actually think. So every financing decision, whether it's a bank, a credit union, a BDC, or a private investor, comes down to 5 factors. If you remember nothing else from today, remember these 5, and that would be a good takeaway. They're sometimes called the 5 C's of credit, and every lender evaluates them whether they say so explicitly or not. The first is character. This is you, your personality, your track record, your credit history, your reputation, your relevance to the given business project or opportunity at hand. Lenders are backing you, not just the business. They want to know, has this person demonstrated integrity? Does he have technical skills to run this? Has he managed for contingencies and redundancies? Have they managed their previous obligations responsibly? Are they financially smart? Do they show up prepared? The character lens is through which everything else gets evaluated, and you get placed in certain risk buckets based on that. The second is capacity. This is the number 1 factor for banks. Can your business cash flow actually service the debt? If you're asking for $500,000 in loan, the lender wants to see clearly a path to profitability and repayment such that your business generates enough cash to make those payments comfortably. This is where your debt service coverage ratio comes in. That's a ratio that helps you understand that metric. And if you do not know your DSCR, you're not ready to apply, and it's that simple. Third is capital. This is your skin in the game. How much of your own money are you putting into this deal? Things like down payments, equity, retained earnings, any other assets. If you're coming in asking for 100% in financing with 0 of your own capital at risk, that's a non-starter for almost every lender. That is a tell that you're trying to be so risk averse that you're not even willing to take risk in the business. How are you going to sustain it? So depending on the deal type, do expect to bring anywhere between 10 to 30% to even 45%, given the type of deal, its structure, the industry, the type of business, the revenue model, everything. So this capital structure decision becomes very important, not only from a lending perspective, but also has implications on the future operations of your business. The fourth is collateral. These are the assets that back the loan, specifically for an asset-backed loan. Real estate, equipment, inventory, receivables, intellectual property. Lenders want a second way out, so they look at all of these assets to look at what their floor of their risk is. If cash flow fails, what can they recover? The stronger your collateral position, the more comfortable the lender is with the deal. And coming back to point number 3, your capital is also a form of collateral. It tells you how much skin you have in the game. The fifth is conditions. This is sort of the broader environment in which your business, prospective business or current business operates or will be operating. What is happening in your industry? What is the economic climate, legal climate? Is your sector growing or contracting? Lenders want to understand why your business thrives in the current environment, not just in theory, and what sort of a roadmap you have around it. So here's a critical tip, and I want you to really hear this. The most number of applications fail because the business owner can speak to maybe 2 out of the 5 or 1 out of the 5, and maybe they know their cash flow position really well. They've got some collateral, but they haven't thought out the conditions, or they haven't really assessed their credit scores and personal credit. All of these are equally important. So if you can walk into a meeting and speak to all 5 clearly, succinctly, and confidently, then you are ready. Or I won't say ready, but I would say you're prepared and better off than probably 95% of entrepreneurs out there. Let's dive into the distinction between, or I guess, distinction that trips a lot of entrepreneurs. There are fundamentally two lanes of financing, and they're interchangeable. They're not interchangeable, sorry. Choosing the wrong can cost you a lot of time, money, and credibility in the eyes of lenders and investors. So on the left side of your screen, you've got debt financing. This is your banks, your credit unions, the BDC, government-backed programs like Canada's Small Business Financing Program. With debt financing, you retain 100% of your business. You get predictable payments and a defined term, but you need collateral, and you need to prove cash flow. It can be prospective cash flow as long as there's a methodology and the right sophistication to building your financial projections. This is ideal for things like purchasing, you're starting a new business, so you want to purchase equipment, you need real estate, you may need specialized assets on the manufacturing side and things like that. So debt financing can be seen as a scaling agent. It'll help you achieve a certain level of operational scale within a given period of time. And the cost of debt, and this is a general rule, Finance 101, cost of debt always remains cheaper than cost of equity, which means that cost of debt, aka interest, is always going to be lower than getting an external investor who's demanding maybe 15, 20, 25, 30% return for deploying their capital in your risk profile. Having said that, the CSBFL or CSBFP mentioned here specifically covers up to 1.15 million of eligible capital expenditure purchases. It's government backed, but it's still fronted and provided by your financial institutions following similar metrics. The only advantage of a CSBFP style loan is that because it's government backed, the lenders have a little bit more comfort taking on more risk than normal. On the right side, you've got equity and growth capital. These are your angel investors, private equity, mezzanine financing, and other family offices that want to be part owners within your project. This lane may involve giving up equity and may involve, meaningful ownership dilution. The terms are more flexible and aligned with your overall growth rather than a fixed payment schedule, but it's completely based on your potential. It's not just your current base of assets. This type of capital, we like to term it as patient capital because it's much longer, they're willing to take more risk, and it's for very specific types of business mandates. But FYI, this is important to note, that these investors will always want a seat at the table. They would want to be able to dictate strategic direction, how things need to be done. They would want involvement. They would want obligations around financial reporting, general reviews from time to time. and they're expecting a financial return out of this for them. So for most of you on the call today, you're likely in the debt financing lane, and that's great. It's the right lane for most small businesses. But even if you're not pursuing growth capital right now, understanding both lanes helps you make a smarter decision around how you want to be structuring your deal, and how you want to be preparing your overall business idea and portfolio such that both are equally leverageable in different stages of when your business progresses.
Udayan, we just had a question related to those.
Sure.
And maybe you'll touch it later on here, but just elaborating a bit more on what cautions that startups need to pay attention to for the debt financing versus the growth capital.
Are there any specific questions around that, or
just
caution?
Yeah, just cautions they may need to think about. If there's anything to maybe add, I know you covered a few.
Yeah, well, we'll get into that in more detail, but what I can share at this stage right now is that in terms of pros and cons, both sides have pros and cons. One is not better than the other. They're both vehicles of operation and growth. You're always looking at angels, private equity, and mezzanine capital for more mature businesses, or you're looking at them from a very, very high risk standpoint in the venture capital side. In those cases, there are specific investment mandates that these investors follow, and they will not deviate from that. So unless your type of business can achieve those metrics, you're not really their ideal market to grow their capital and have a financial return. On debt financing side, it's a much bigger world. Lenders are willing to look at all potential traditional small businesses, startups, growth businesses throughout their life cycle. As I explained earlier, debt financing is cheaper than looking at equity capital. It's a scaling agent, so it helps you scale much faster. And you retain 100% of ownership of your business. Or even if it's, say, a group of 2 or 3 investors, the ownership, strategic direction, and responsibility all lies with you under the debt financing side. So a word of caution on debt financing is that we've seen clients lever up too much, which means they take on a lot more financing that they actually need because the business planning effort put into it is below optimal and subpar. So they don't really know how much capital they need. Too much of a capital is also a problem. Too little capital is equally bad. You want to be optimally capitalized because that affects your cash flows, your cash flows to owners as well as cash flows to lenders. It affects how much of an equity you have parked for maybe future projects and things like that. So that's important thing to consider in debt financing. In growth capital, from a philosophy standpoint, do not approach growth capital with a greedy mindset. It will always backfire, and you will always sign up for certain terms, conditions, or obligations that you don't realize what they entail, and then eventually it breaks those relationships into a corporate divorce. So that's, I guess, those are 2 high-level points that I can share for each and every one. I think the next slide might be more relevant because it talks about what can kill any of these applications.
Okay, perfect. Thanks.
So this is something that is probably the meat and potatoes of today's presentation, is the deal killers. What will kill your deal regardless of what type of avenue you choose. And so the 6 most common reasons kind of why loan applications get declined can be summarized into these categories. The key message, though, is that every single one of these is flexible if you catch it early. Let's start with inconsistent financials. This is the first thing. Your tax returns and your bank statements and your management accounts and projections, they all need to tell the same story. And you would be surprised in almost over 85% of the times, none of these actually follow the same story, the same model. If your P&L shows 2 million in revenue, but your tax return shows 1.4, you're showing a loss on your tax returns, but you're asking lenders that you're going to be a profitable business. Those stories don't align, and it's an instant rejection right there. Lenders will cross-reference everything because they're placing a bet on you. Cleaning it up before you get to a stage of a transaction like this is always not recommended, but mandatory. No skin in the game, as we talked about earlier. So if you're coming in with little to no equity, lenders see that as a risk signal. They want to know you have something to lose because it keeps you accountable, responsible, and there's a lot better chance of your own success. So typical equity injection can range from 10 to 30%. Is what we see standard. That may not be ideal. Sometimes a 50-50 equity debt split is a lot better. So it really depends on the type of project and the loan program that you're trying to go after. Not thinking this through, huge issue. Unresolved credit issues. Don't let that be a surprise. Do your credit checks before you approach a lender. A soft check with an overall credit score is more than enough. Lenders will do a hard check. Something to note is that if you're approaching a given lender, say you've recently done a mortgage application, now you want to start a business, and you're worried that each of these hard checks will prove negatively on your score, don't worry about it, because the way these get counted within a certain period of time, all of these credit checks get bundled up. So you are not eroding your credit profile by doing frequent credit checks. Best practices, at least have a credit score of 650, if not higher. The better the credit score, the better your chances of the first time financing application, if that's your stage within your business life cycle. Fourth, vague use of funds. Okay, we need 500,000 because we need money for XYZ, but not really being able to, quantify that, break that down over the asset base that you're acquiring is a huge red flag. Saying working capital isn't enough. Lenders want to see a detailed breakdown. They want to see, okay, how many costs are going in marketing, hiring, inventory, build out. What does the timelines look like? What stage of permitting are you in? Have you looked at all alternative options? Is this the most efficient project cost breakdown that you can come up with? So dollar amounts tied to a business rationale, tied to a time frame, roadmap, and specificity. Very, very important. If they're giving you their money, they want to know what's happening with it and how they can recover it. The fifth one is no advisor or succinct deal structure. And going in without a financial advisor, a CPA, a deal quarterback, for lack of a better term, it signals inexperience. Even if your business is strong, an unstructured approach tells the lender that the deal isn't packaged. It will have deficiencies. It may have landmines that are unexpected. So having an advisor adds credibility and moves your deal along faster. It helps you achieve that goal a lot faster. Time is money, and so the faster you're able to get into the market, build a position, the higher your financial return as owner-operators would be. And lastly, and this is something that people never think about, which is surprising, is not having a transaction budget. A capital transaction such as this is a huge event in the life cycle of a business. And so not being able to comprehend that, number one, and then being caught off guard much later in the process ends up being one of the biggest landmines we've always seen. We've seen deals that clients have worked on for half a year to 8 months, 9 months, over a year, fail and fall because of this last point. Beyond the loan amount itself, you need to budget for closing costs, legal fees, appraisals, environmental reports potentially, and some reserves to show that you have some operating cash to support the business in its first 6 to 8 months, as well as professional advisory fees. Lenders want to see that you understand the full costing of closing as well, not just the sticker price, because why would they want to waste time if you can't close on these deals? If your sources of funds don't balance with your uses, including a transaction cost budget, then the deal stalls automatically. So a key takeaway from this slide is that none of these are death sentences. The sooner we start working on them, the better. They're all fixable, but you have to identify and address them before you walk into a lender's office, not after you start an application with them. But having said that, I think it's also important to note that, again, tying this back to credibility, tying this back to your character, tying this back to the 5 C's, this ends up providing you with an important important map of the most important things that need to be worked out beforehand. We will move to a special section here, which is franchise and acquisition financing. So there are various types of small business owners. Sometimes you don't have a project or an idea in mind. You're not a professional, so you're going after Main Street businesses. And franchising always helps. It offers you a variety of potential investment opportunities to study and to pick which one's right for you. There might be certain big ones like a McDonald's or a Tim Hortons, but there might be small ones like an Ultimate Coders or a Fabutan. It really depends on your selection, your risk tolerance. And so franchising offers you a plethora of opportunities there. Specifically in the case of franchise financing, lenders look at 4 things. First is the franchisor's track record themselves. There are franchise brands that have preferential access points with lenders because of how big they are or their type of business model, and lenders have had past experience with them. So of course, the deal is a lot more likely to be done. When you're buying into a franchise, lenders are evaluating, not just you, but the brand itself overall. So a strong franchisor will have a proven system that gives lenders comfort. The franchise disclosure document, or the FDD, is your financial story. It tells you a lot about the franchise operations nationally, regionally, how they apply to you. It tells lenders a lot. Lenders will review it closely, especially things like past earnings of the franchisor as a group and things like that. So you need to know what's in that document inside out if you're going the franchise route. The CSBFP tends to be a go-to tool for franchise financing because you're setting up a booth or a shop or an operation. And so you need to start by buying assets that are generating revenue for you and can cover up to, as I said, 1.15 million in equipment, leasehold improvements, as well as real estate. And the fourth is, again, equity percentage, recurring theme. You got to bring in the right kind of equity, but that tends to depend a lot on whether your business model is service-based, food-based, widget-based, what type of brand it is, what type of location you're choosing, and things like that. On the acquisition side, this is another way small business owners grow or start their journey, is they buy out an existing business owner. Typically, what I can identify as successful deals versus high-risk deals is that in the successful bucket, people that are looking at business acquisitions as a tool to be entrepreneurs have had some level of exposure or experience in that field, or they have had related exposure experience or gained those technical skills in other areas of their life that directly apply to them coming in, buying an existing business, and starting their journey right off. So they are not wasting 2 to 3 years in building it. Both have their own advantages and disadvantages, but we'll discuss that potentially on another day. In the acquisition financing side, if you're trying to buy a business, whether that's a franchise business that we just talked about, or a standalone business, or an industrial manufacturing, any type of business, a valuation always helps. It tells the lenders what the business is worth. It tells the lenders what sustaining future cash flows could look like, what adjustments need to happen to those, how you would be operating the business versus how it's currently being operated will have an impact on that. Vendor takeback tends to be another source of financing where the seller themselves will finance a certain portion of the buyout price in exchange for the entire transaction. Now, these tend to be very, very expensive compared to traditional funding opportunities that you get from FIs. But they are used often to close gaps in case the lenders say, okay, we don't want to lend more than this, and things like that. Does not work. It's not a one size fits all. Does not work for every type of deal. Sometimes for strategic reasons, you don't want the seller to be involved as a lender in the future and things like that. So you want to have a strategic exercise on seeing what that looks like. Historical earnings, last 2 to 3 years of financials. Are your financials good? Have you done the right normalizing adjustments of one-time expenses and borrowing capacities, and how your historical track record of your profitability has been? Are you good on your compliance with respect to tax and other reporting requirements? So all of these things are important. And then last, of course, is proven cash flow, right? So this becomes a lot more appetizing for lenders because they see this is a business in operation. It's been generating revenue. It's been generating some level of cash flow. And so there's a much greater path to their security in lending you a given amount because there is evidence here that the business is making cash. Some people try to get creative and they want to, acquire businesses that are struggling because they think they can get a better price for it and they can turn it around. From a lending perspective, it's much harder. There are much higher equity requirements. There might be more specific restrictions that the lenders impose in the form of financial and non-financial covenants. You got to maintain, this amount of cash, or you got to maintain at least this much reserve. You can't have more than these many assets and things like that. So things get very complicated very quickly. So let's get into, before we get into this slide, are there any questions that the audience has?
Yeah, just a couple questions relating to, one to the FDD. Is it an actual statement that the franchisor has to disclose their financials to the lender? And what does that look like?
So there is this is a gray area, right? It's a wide area of possibilities. More sophisticated, bigger, capital requiring franchise brands tend to follow a given structure. Smaller, lower tier brands that are easy to get into follow a different structure. In terms of the requirement, the FDD is not just important for the lender, but for you as a potential owner. You need to understand what is this system all about, what has their success been, what are the risks and challenges. The FDD explains all of that in immense depth. It'll talk about things like our sales grew by X amount, or these are the number of stores we have, these are the number of stores we have planning, or these are the number of stores we closed. It'll talk about audit requirements that you have to fulfill. It'll talk about system reporting requirements. How is the royalty structure set up? How is exit or expansion set up? So if you want to grow to a second location or a third location, what are the obligations you have towards the franchisor and things like that? So it's as important of a document to lenders as it is to you. It tells you who you're marrying, and this is more of a prenup. It is like the simplest way to explain it.
Yeah. Awesome. Thank you. And the business valuation is everything. Is there how can a stakeholder guarantee that business valuations are accurate?
So firstly, the business valuations you're getting done need to be from a credible source, preferably an accredited member of a professional institute in good standing. Now, these tend to be pricey. So again, coming back to our original point of closing costs, these are transaction costs that are important. Not every type of business structure or transaction needs a full-fledged business valuation. Uh, if you're buying, so acquisitions are of two types, right? You can buy assets of a business, or you can buy the business itself by way of buying its shares. In the case of buying a business's shares, these loans tend to be called, like the common parlance is cash flow based loans. So since you're buying the shares of the business, you're buying both assets and liabilities of the business, and its future cash potential. And so because these are high risk transactions, you tend to require an evaluation so that you understand whether the pricing multiple that you're buying this business at is good, whether the sustained maintainable cash flows of this business are good, what sort of verification procedures have happened in it, if at all. Are there any adjustments to your bottom line of profit that the seller is reporting? Does that require any adjustments? And then you do your debt calculations and things like that. So it gets into that level of complexity. If your project sizes are bigger than $1 million when you're acquiring a business, and trust me, I have seen first-time business owners do that, this becomes your source of truth because these are independent. It's just like having an auditor come in and audit your financials so that you can raise more financing or equity and things like that. So same thing happens in the case of independent business valuations. And that independent word is critical here. In the case of asset purchase transaction, there we limit the scope to things like asset appraisals, right? Appraisals on leasehold improvements, flat out purchase costs if they need to happen. So business valuation is a general term, but from an acquisition standpoint, a lot of these businesses get acquired for shares. And so it's important that we discuss that.
Great. Thank you.
Awesome. Are we good to proceed?
Yep.
Great. So this is a framework that we often share with our clients. I want you to be really honest with yourself here. I'm going to walk you through these 6 questions. For each one, I want you to mentally rate yourself. Yes, partly, or no. This self-assessment will tell you exactly where you need to focus before you think you are ready for financing. So there might be a quantified method of doing that, and this is a qualitative method, and both need to happen. Question 1 being financial records. If you're a first-time business owner, do you have your tax returns filed? Are they accurate? Can you show that you've had a good track record of income coming in? If you're an existing business owner, last 3 years of clean financial statements and tax returns. Not just filed, but can you sit with the lender and explain them the story well? If you can't, that's your first area of focus. Second is credit health. Do you know your personal credit score? Do you know your business's credit score? Not what they were 2 years ago, but as of today. If you don't, pull them this week. Third question is equity position. Do you have 15 to 30% equity available for the deal? Plus, say, 5% for overall transaction costs. That could be coming from cash, your existing assets, investments, retained earnings. If you're short on equity, do you need a plan before you approach a lender to build that much equity? Or if you're short on equity, is that the project that you want to be approaching with the limited equity that you have, right? So a project assessment and a fit assessment is also important. Question 4 being collateral. Depending on the type of business you're going for, what is the total approximate value of collateral you may have, or collateral that you're planning to buy, which the bank will have a first charge against? If you can't produce a list, a lender can't either. So that's homework that you need to at least start doing. And fifth being the use of funds. Can you explain exactly what the money does and by when? Not vaguely, but specifically. So every dollar accounted for with a clear sort of timeline and expected outcome. And question 6, of course, the cash flow story. Can you show that the business generates enough revenue or will generate enough revenue to service the debt? And this goes back to capacity conversation that we had earlier. And if you can demonstrate this clearly, the application will stall. Now, in the case of cash flow story, one thing to note is not any assumption will be bought, right? Assumptions need credible sources of research, and that needs a specific laser-focused angle and study period. So unless you can back your assumptions with evidence, and that evidence is credible, coming from credible sources, you can't just say that you're planning to make $1 million in your first year, you want to grow exponentially, but not have a way of doing that. 99% of the businesses, unless you're in some sort of a VC-backed tech AI fancy startup, will not make $1 million within 6 months to a year. So be realistic. The more realistic you are, the more honest you are, the better it reflects on your application. So now, if you've answered yes to all 6, great, you're in an excellent position. Let's grab a coffee and continue this conversation. If you've answered partly or no to any of them, great, let's grab a coffee and have a conversation. Don't apply until you've addressed them. A half-baked deal is itself a deal killer than anything else. So it's much better to take an extra month or 2 in perfecting and fine-tuning everything that you can before approaching and being quick and hasty. Which brings us to your business plan and the first impressions. So because this is where I see most of the wasted opportunity. Your business plan is your first impression with a lender. Lenders don't fund ideas, they fund documented evidence-backed plans. So the cost of a weak plan is real, it's immense. You get immediate credibility loss, you get lower loan approval amounts than you actually qualify for, because the lender doesn't have confidence in these numbers. And you get months of delays, back and forth, fixing everything, resubmissions, things like that. I've seen entrepreneurs lose 6 months after application because they've submitted a plan that wasn't ready or was subpar and unprofessional. So what do lenders actually read? 4 things. Of course, the executive summary. They decide on the first 2 pages whether to keep reading or pass. So if your executive summary is weak, vague, reads like a marketing brochure, incomplete, lenders stop there right away. Lenders don't even get it reviewed by their credit teams. Second, the market and competitor analysis, the most important. This needs to be done sophisticatedly, independently. Data-backed research has to happen. Not that market is large, and even if you can 1% of this, we'll make a lot of money and things like that. You need to have a way to address and size your total addressable market, your serviceable market, and then the realistic market within, say, a neighborhood, in the case of a coffee shop or a massage place and things like that. How many competitors exist? What sort of saturation exists in the market? Is there saturation? Does the market have appetite to get more supply of this product or service? Everything. And it's not that you're trying to find these numbers to convince or impress the lenders. It's to protect yourself. You are also liable for 30% of your hard-earned money here. So if your idea or the market conditions don't support that, don't move forward with it. There will always be something better out there, but requires more time and effort in searching. And that's I always tell that to all my clients there. So it's not about being disheartened, but looking at it from such an overly critical standpoint where you are yourself a more realistic and a more conservative approver of this plan than even the lenders. Third is financial projections. They are expecting at least a 3 to 5 year pro forma with realistic assumptions that tie back to your research. Lenders will want to stress test these numbers and you have to be answerable to each and every number that goes in. And the last being the management team. In small businesses, the owners themselves are managers. Sometimes they hire specialized management talent to support them. So being able to, articulate their track record, your own track record, your relevance to the experience to the project, and any gaps that exist currently, and how you're planning to address those by way of training and hiring people and things like that. So lenders want to back people, not just spreadsheets. The payoff of a strong plan is significant. You get faster approvals because lenders already trust the numbers. Sometimes clients approach an application with 30% equity, but realize that after the interaction and the whole application process, the lenders are saying, no, don't worry. Instead of giving you 70%, we'll give you 85 or 90. We have good credibility based on our own, assessment of you that this is good. So you're already starting with a much stronger base there. So higher approval amounts, because you've justified the ask. Better terms because your perceived risk by a lender is lower, which means better rates, more flexibility on payment schedules, and then things like that. So it's a definitely competitive edge. Imagine a competitor in the same space, two coffee shops with one 90% funded by debt, one 40% funded by debt. Two different profiles. They may have a lower debt payment, but they also have lower capital to invest for future projects. Whereas in this case, they have a higher debt payment, maybe more flexible payment terms, but they have a lot more reserve capital to invest in the business, steer it around in case of any positive or negative fluctuations from the market, and invest in future projects. Big difference. But on the outside, they will both seem like a franchise coffee shop, right? I want to spend a moment on this because this is the single biggest weakness. I see in business plans that come across my desk, preliminary work that clients have done. The market is growing, won't cut it. Lenders want proof, not assertions. When I say independent, I mean third party, cited, verifiable, not the founder's opinion about the market. Lenders want to see four things, total addressable market, cited from professional sources like IBIS World, Statista, government data from Statistics Canada, not estimated by the owner. How large is your market realistically based on geography, demographics, and distribution channel? You have a competitive landscape that you want to capture. List your top 3 to 5 direct competitors, their strengths, their weaknesses if needed. How do they price in the market? What sort of industry trends are they following? What you need to be following? All of that. This kind of rigorous research changes the outcome hugely, immensely. It de-risks the whole deal for the lender because it shows you've done your homework, your math and your research is better than theirs. It validates your financial projections, revenue assumptions that are backed by market data. They are credible, they're not unsupported. It reveals your competitive mode and it creates a great impression. That's also something that you want. Addressing all of this helps you identify for yourself and the lenders why you will be a winner in this market specifically, and why not somebody else. What is it that you're doing? What's your secret sauce? What's your specific recipe for your tasty beer that you're brewing, right? And so most business plans skip all of this and do a very shoddy job. They'll try to bring, research of a national level for a local type of business. They'll get information from the US because they can't find information for how that applies to their local market and things like that. So at Vajra, this is kind of a core part of what we deliver. We have our own primary research function in-house, so we'll get data that nobody else has, but also match the same level of research metrics that lenders do, so that we have some sort of parity. We are seeing the same things. Of course, our research is region-specific, customer-specific, client-specific, industry-specific. So it's a lot more relevant, and you can talk a lot more and understand what sort of project scope and risks you actually face. And we build that directly into the business planning work we do for our clients. Now, in terms of financing structures. There are ways of getting finance, primary financing and growth financing. So building on our earlier conversation about debt versus growth capital, I want to draw a more specific distinction. When we talk to clients, we classify financing into two lanes: primary or growth. The documents, the structure, and the lender expectations are completely different between these. Primary financing would be something for people that are starting operations from scratch. New business launches, new franchise units, new location with no existing revenue. This is where conventional loans coupled with the CSBFP style purpose-built, loan amounts, they come in handy. With primary financing, lenders are relying entirely on your market research, your financial projections, because there's no historical revenue to evaluate. That means your business plan is everything. It's so much more important. So the stakes are much higher. It's the only evidence that the business will succeed, and expect a higher than normal equity requirement, although recently we're seeing that they're kind of similar across different purposes. Of course, you're trying to open a restaurant in a sea of restaurants, or you're trying to open a coffee shop in a sea of coffee shops, does not help your case. You, of course, need a lot more equity contribution, because you're competing with existing and older businesses that are much further along paying off their own business loans too. Growth financing is for things like acquisitions, expansions, and specific type of capital projects. Your historical performance is the anchor here, of course. Lenders want your EBITDA history, your earnings before interest, tax, and depreciation. And that's what EBITDA stands for. Potentially a valuation, of course, a business plan that supports the project. For expansion or multi-unit deals, say you have 500K in capital. Now, instead of doing one project, you think you can do 2 or 3 projects at the same time. That's where you simply tap into the growth financing style of project development. And for major capital projects, return on investment, payback periods on how quickly can you earn back your principal investment becomes very important. Growth deals are often layered. So you'll have you'll have a CSBFL structure, you'll have conventional terms, you'll have 2 lines of credits going on and stuff like that. So there's all sort of engineering that you can do around structuring your capital. So I want you to take a moment and ask yourself, which lane am I in, right? And because you know your lane best, and the preparation path becomes a lot clearer once you self-recognize based on these buckets. Of course, so how does this all come together? At Vajra Capital, we just don't advise, we build the deal with you and get it done right from scratch to the finish line. So I can briefly walk you through the process of our 4 sort of core services. First is, of course, business planning. So we build investor, lender ready, investor grade business plans that speak the language that lenders understand. These aren't narrative; they're backed by sophisticated data-driven financial models, holding up to scrutiny. They help you prepare for your own business financials for the first however many months post a transaction event. Of course, financial modeling, so helping you commercialize your products and services and having a more modular approach to it. So we will build pro forma projections, understand sensitivities. Okay, if interest rates go up, how does that affect my debt? Or if I get these many sales, how much inventory do I need? And things like that. So cash flow models tailored for the specific deal and lender requirements, but also for your own commercial operations. And of course, third is financing advisory. So we are specialists in identifying the right lender or the investor for the right type of business vehicle, opportunity, and investment structure. We'll help you structure the deal in and of itself, prepare your full financing package, your lender support documents and for the application, and represent you in front of lenders there. So you're not walking on alone, and we're not leaving you hanging out to dry after we're done. And the fourth, of course, is business valuations and valuation related advisory. So of course, valuations around experience, illustrative pricing analyses to see if this type of a business should be priced this way or not, And if you're planning to also sell your business, how does that work? We can help you with that. How would you want to structure buyouts of, say, partnerships, plan your estates, and things like that? So the numbers become a lot more defensible. So everything I've talked about today, from the 5 Cs to the business plan to the market research, structuring of deal, that's what we do for our clients every day. A combination of these or independently. And of course, with that comes the advantage of accessing our network of relationship partners. We're looking for, you have a capital, but you don't have an idea in mind. You're looking for certain business opportunities. We can make the right introductions. We work with a lot of corporate franchisors in that space too, to share information. So we're very well positioned from that perspective, as well as having deep relationships with all major lending institutions, credit unions, and other alternative financiers that share with us things that they are looking for out of the market. Just something that we're proud of. These are some of our very early small business clients. All of them, either acquired or started something of their own. These are live businesses. We welcome you to, of course, they are clients, so we will of course promote them. We welcome you to visit any of them, Sherwood Park, Beaumont, Edmonton, experience their services, their products, their way of doing the business, and learn from that too. Having said that, these people are from very different backgrounds. One's an ex-banker, one's a 20-year seasoned restaurant operator and cook and chef, and one is a teacher that wanted to start her first business venture and things like that. So people come from all walks of life, but we get them from that point, ride the learning curve with them, and make sure they become more sophisticated owner operators going forward. So if you're in a similar position, we'd love to chat with all of you. If you have any questions, more than happy to answer them as well. As a courtesy to Business Link and our great relationship with them, we do want to offer this chance to all attendees here today. If you scan this QR code to the left of your screen, you will be able to book, a financing readiness call with us, completely free of charge. And we can go over your scope, your ideas, your questions, your confusions, anything for that matter. Once you're making the booking, we'll instantly get in touch with you, set up a virtual call or a destination, and go from there. Outside of that, please visit our website. That phone number is my direct line, so feel free to give me a call or text me. And for all other general purpose inquiries, that email will serve you as, and somebody from our team will get in touch with you. So thank you so much for your time, and I hope you guys all make it through. In your business journey, it's all topsy turvy, but I just wish you all the very best and all the luck. So David, I'll hand it back to you.
Perfect. Thanks so much, Udayan. It's great to kind of see from your perspective how getting funding is really important for a small business owner and what they really need to truly prepare, right, to kind of wow any investor, right, whether they're getting debt financing or through an angel investor, venture capitalist, things like that. So really great insight there. We do have time. I know we're at the hour here, but just one really quick question that I think is important for maybe folks joining. How does someone pull their business credit report? Just a quick thought on that.
If you create a profile on something like a Credit Karma, they typically will help you connect with either Equifax or TransUnion, which are the two entities in Canada that track credit scores. So just going on that website and entering your details, setting up an account will help you have them pull that data for you, and you can review them from month to month as well, and they'll send you notifications on if there are any changes or any hard checks and things like that.
Perfect. Thank you so much for that. So on that note, we'll bring today's session to a close. And again, Udayan, thank you so much for sharing your expertise and helping our entrepreneurs just better understand how lenders evaluate businesses. And thank you to everyone who joined us here today. We know your time is valuable, and we really appreciate you spending your lunch hour with us. Now, if today's session did spark any ideas or questions, you can always book a free one-on-one meeting with one of our Business Link Alberta strategists. Feel free to visit our website to do that. And we'll also follow up by email with the recording and resources mentioned today. And before you go, we'd really appreciate if you could complete the quick feedback survey. Your input does help us to continue to improve our programming. Now, before we wrap up, I also wanted to quickly share an upcoming in-person event that might be especially valuable for some of those newer to entrepreneurship in Alberta. On March the 19th, we'll be hosting our Entrepreneur Forum for newcomers in Alberta at the Edmonton Convention Centre. It'll be a full-day forum designed to support newcomers who are exploring entrepreneurship, self-employment, and small business ownership. The day includes practical learning sessions, resource fair, structured networking, and complimentary lunch and refreshments. We'll be covering topics like business basics for newcomers, funding and grants, AI basics and digital marketing, and you'll have the chance to connect directly with organizations that support entrepreneurs across Alberta. Tickets are just $10 to attend that. And if you're interested, I'll drop the link in the chat or scan the QR code on the screen, and we'd love to see you there. So again, thank you to everyone for joining us here today, and hopefully we'll see you at some of our upcoming webinars. Thank you so much, and take care.
Thank you. Thanks, everyone.